How's it going, everyone? It's Sam. It's been a while since I've done one of these, and I am very excited. We're going to look at how much Bitcoin you need to retire. And obviously, it's going to be different for all people's situations, depending on where you live, how much you need to spend, where you think Bitcoin's going to go as well, when you're going to retire, and all that. But we have more options. We have more options of retiring on Bitcoin now. There are some creative things you can do. And of course, make sure you understand these options before you start implementing them. But it is very cool to explore 3 different ways that you can retire. If you don't mind, hit subscribe, turn on the bell notification underneath the video so you can see future videos just like this. As soon as I make the videos, you can get them. Also, there's going to be a link underneath the video to Margex where you can trade cryptocurrency using leverage. I'm not going to be going through retiring using a leverage trading strategy today, but just know that you can amplify your stacks of crypto if you do this properly. Of course, make sure you understand the risks, but there's no KYC. You don't need a VPN, and you can start trading in just a few seconds over on Margex. Now, the first way, the first thing that people have to understand, right, with Bitcoin, it's very volatile, which some people love, some people dislike it. Now, what does this mean? Well, it means that you can get outsized returns. Right now, over the last 10 years, you've been able to get somewhere around a 50% annualized rate of return. What that means for you is if you do this correctly, you can make a lot of money and you can retire early. What it also means is if you are emotional, if you do not look over the long term, if you do something stupid, you can lose your crypto, you can lose your value very quickly as well. So after you've been in the game for a while, and after you've been investing for a little while, you start realizing, okay, I need probably more than I thought to retire, right? At first, especially when you're single, you're thinking, okay, maybe I need $30,000, $40,000 a year to retire, and then you get a wife or a husband or a significant other, you buy a bigger house. You realize, well, if I retire, I'm going to have to pay insurance, most likely. You have a kid, and you're looking at 6 figures, right? 6 figures in expenses. And that's not the case for everyone. I've done multiple videos where I look at different places to retire, but that's the situation that a lot of people are in. Now, with Bitcoin, with it becoming institutionalized, there are 2 new ways of retiring on Bitcoin that I find very interesting. The first one has to do with options. And people always think options are so risky. Depending on what you do in options, they can be risky. Otherwise, they can actually be risk off. They can be, in a way, less risky than actually holding the shares. So let's look at this. First of all, NVIDIA. I know, kind of weird, we're talking about Bitcoin, but NVIDIA has a stock beta of 1.76, basically saying the volatility that they measure is 1.76. This is kind of an arbitrary number, but this is how they measure it. Bitcoin, on the other hand, has a beta of 2.02, meaning it is more volatile even than NVIDIA. And NVIDIA is very volatile. Like, look at this chart. It can go up, then fall down 26%, and then go right back up. But keep in mind, Bitcoin does that in an even shorter amount of time. And while NVIDIA is up a lot, Bitcoin is up a lot as well, being up 4x from 2 years ago, less than 2 years ago. So what I wanted to do was look at options. Options are actually coming to Bitcoin, and how a call option works. Just stay with me here because this is important. How a call option works is if you sell a call option, you're selling the right to someone else to buy your underlying asset at a certain price. So you might say, okay, NVIDIA is $119. I am going to sell it, and I will sell it to you at $130. Okay, so 6 months into the future, if it's 140, you can buy it at 130. But to do that, you have to pay me a flat fee up front. That's how selling calls works. So if the price stays the same or goes down and you sell the strike price for 130, so they can buy it at 130, anywhere up to 130, they're not going to exercise it. So you just get that fat premium up front. You get paid just to sell that covered call, and you don't actually have to get rid of your shares. However, if it goes up to 135, let's say, well, then the other people get their shares at 130. Now, this actually can pay pretty well on volatile assets. This is the whole point, that right now, actually when I ran these numbers a few minutes ago, NVIDIA was at 118. So let's go with that. You could sell options for 6 months from now, 6 months. So you could do this twice a year. You could sell $130, $129 strike price for $14. You get paid $14 in premium per share. These are in 100 share contracts. So you get paid $1,400, and someone would have the right to buy your shares from you at $129. So basically, you let's say the price stays the same, you get $1,400, which is a nice return in and of itself. It's about 12% premium over 6 months. So you could do this twice a year, get 24% if the price stays the same or even goes up slightly over that time. You would come out ahead. Now, what if it goes up to $140? Well, you still come out ahead because you're selling at $129. You got $14 a premium. So the break-even price is kind of $143. If it goes to $144, well, you got still a good return. You have gotten more from just holding, but you still got a 12% premium. You got to sell your shares at 10% higher than it is right now. So you'd get like a 22% return in 6 months. Now, maybe you miss out on some upside, but I bring up NVIDIA specifically because we know options are coming to Bitcoin and Bitcoin ETFs. You can already do this with some Bitcoin-related stocks. I've done this with CleanSpark, for example. I've bought calls. I've also sold calls in the past. So you could do something like this, and let's say you do get 12% every 16 months, every 6 months. So you get 24% a year. If you hold $400,000 worth of Bitcoin, you could make about $100,000 in premiums. And that would still give you good upside appreciation. It would give you 10% every single 6 months. You could go 10% up and get the 12% premium. Now, of course, if the underlying asset falls down, you're going to get paid less in premium. So you might get that same 12%, but say your $400,000 worth of Bitcoin goes down to $200,000 of Bitcoin. Well, then your premiums go down to what would be about $48,000 or so, under $50,000. So that is some of the risk. Also, if it goes up significantly, you have to sell, right? Or you have to get rid of your shares. And then it might be a little bit hard to buy back in. Then you're looking at probably the wheel strategy. I actually have videos on that where you can actually sell cash secured puts. So you can actually get paid to buy if the price falls down. Some people like that as well. But this is just one way of getting cash by holding an asset. British HODL actually goes through this. This is why options on Bitcoin ETFs is a mind-bending game changer. Let's say you have $100,000 of Bitcoin in an ETF. You're able to sell a call at 1% a month. Extremely safe. That's essentially what I was talking about. But let's say you get 1% a month, which is even less aggressive than what we were talking about here. Here we'd get 2% a month, and we were doing 6 month contracts. Probably makes more sense to do a 1 month. You make $1,000 a month in income with no tenants, no maintenance, no lawyers, no mortgage lenders, no bullshit, no intermediaries really. 100% profit. And in the next 4 years, if it goes to $400,000, you'll now make $4,000 a month with the same risk profile. This might not be relevant to non-financial astute investors, but intelligent investors will be salivating over the product development. In 2 cycles, assuming such a doubling, just a doubling each cycle, your income on that position goes from $1,000 to $4,000 to $8,000 a month. So that would be actually after a 4x the first cycle, but you get the gist. And with Bitcoin's volatility, you'll be able to go so far out of the money that the risk of being called out is negligible. And of course, you'd only do this in a sideways down market, as upside. Bull market returns will always be better with capital gains. This is a monumental addition to Bitcoin when approved in Q4, as Jay Safeart says. And we haven't even touched on the speculative loop that requires institutions to suck up Bitcoin to provide these options. This is really interesting. I mean, you just have to think about it. Even if you're someone that never wants to get rid of your Bitcoin, this is fascinating. The amount of volatility in an asset that you like this, could pay you a lot of money. Of course, there are always emotions that come with this even. You feel like you might miss out if your options get exercised. But this is just the first of the 3 ways of retiring from Bitcoin. Let's look at the next one. Let's say you just do the normal DCA strategy. Then we'll get into something creative again. Let's say Bitcoin's price is $58,000 this year. And for the next 10 years, it goes up 40% a year. Up until it hits $1 million, and then it goes up 20% a year. It becomes a larger asset and moves less. Some people would say this is way too bullish. Some people say it's too bearish, but this puts it at about $1 million about 10 years from now. So you have $40,000 to invest. I realize that's a lot for some people, right? A lot of people, that's an incredible amount to invest, but this is starting from zero too. So maybe you already have half a Bitcoin or something. Basically, you get up to almost 2 Bitcoin. The value of your portfolio after these 10 years is $2.4 million. So just short of 2 Bitcoin. You continue to invest less each year. You only invest 90% of what you invested the year before because the price is going up. So you're investing less. Okay. 4% rule gives you $94,000 a year. Basically, you just go out and you sell a little bit of your Bitcoin, 4% of your Bitcoin each year. And keep in mind, you should be diversified, right? You shouldn't only have Bitcoin, most likely. The volatility will probably kill you on the inside then. But $94,000 a year, great. That is how a lot of people look at retiring on Bitcoin. But what if you want to get a little bit more creative? A lot of rich people like to look at lending and loans on your assets because you can hold the underlying asset, maybe get a low APR, and then you can come out ahead if you play it right. Obviously, there's a lot more that goes into this. This can get more risky, but let's say you do the same scenario for the next 10 years, and we have 20% appreciation. Then the 10th year, it turns into 10%. It moves just like the S&P 500. Of course, there's going to be volatility. There's sequence of return risk and all that. But let's say you continue. You have that about 2 Bitcoin that's worth about $2.4 million. But instead of just selling 4% a year, you start taking loans on it. Okay, so you have nothing invested while you retire. Let's say you retire in 2035. You take a $125,000 loan at a 5% APR. Of course, this could change too. The APR could change. So there are a lot of things you have to pay attention to. At the end of the year, you owe about $131,000. Your net worth then, because this does go up 10%, remember, your net is 2.473, which is up from the 2.368 the year before. Then you take a little bit more out the next year. We adjust 5% for inflation each year thereafter. So you continue to take out 5% more. And as you can see, the price of Bitcoin continues to go up about 10% a year. Of course, there will be volatility. Like I said, maybe a good thing to do, and this is why I actually put this in 125, even if you just needed 100, is just so that way you have a little extra buffer in case there's a downturn or something. And maybe you just have some cash laying around. That could be probably a better solution, because then you don't have to get the 5% on the cash that's just sitting around. But that way, again, if there is some kind of dip in the market, you don't have to sell on one of those bad days or worry about it, because you have some extra months of runway. But you continue to do this over time, continue to take loans. By the end of this, you owe about $2 million, okay? $2 million, which is a lot. But your portfolio is worth 6.14 because you never actually had to sell the Bitcoin, and it continues to appreciate faster and more aggressively than the APR. That's kind of the break even. If the appreciation goes down, or if it's lower than whatever the APR is that year, then you lose out a little bit. Now, if you hold it and then it goes up significantly more, then you win out. So at the end of the day, you'd have about $4.1 million in this scenario, and you start with 2.4, and you're able to live for about 10 years just on loans. But of course, again, there's volatility that comes in that. If we see a 50% drawdown, or like, let's say, heaven forbid, you get a 70% drawdown, a 70% drawdown would leave you with $1.84 million, and you owe $2 million. So you would be liquidated, most likely, or they'd ask for more collateral. So there is more risk that comes with something like this. But if your portfolio is even bigger, yeah, maybe you want to look at it. Maybe you have other assets so you can post more collateral. There are all different reasons to do this. Some people just love doing loans and making sure that they don't have to sell their underlying assets, which has done well over time, honestly, because almost everything's appreciated, whether it's stocks, especially index funds, so that way you don't have to deal with individual risk. But index funds, real estate, Bitcoin, it's all gone up significantly in the last 5-10 years. So if you had taken loans versus selling, you would have come out way ahead. I was just looking at property the other day that was bought 5 years ago, and it was bought for it was bought in the $400,000 range, and now it's selling for $900,000. And it looks like a deal at $900,000. And that's just because everything's gone up so much. So if you're able to hold on to your Bitcoin and we continue to have expansion, we continue to see people flock to Bitcoin, this could be the way to come out way ahead. So we looked at 3 different ways of retiring on Bitcoin. Honestly, the 4% rule or something like it is the safest, simplest way. But if you want to get a little bit, more nuanced, if you want to be a little bit more aggressive, you could do something like selling covered calls. You could take some loans on your portfolio, which both those infinitely easier now that the Bitcoin ETFs are approved, and those are coming. Those products are coming. So we will have easy ways of doing that. You can already do it right now. You can take loans against some of your portfolios if you have Bitcoin ETF exposure, but more and more products like that are coming. There are going to be Bitcoin covered call ETFs where they just sell and you get a dividend every single month. I have mixed feelings about those. Actually, I don't like them usually because they underperform significantly and you can't control exactly how you want to play it. There are tax implications for that too. Obviously, there are tax implications for all of this. So you have to go meet with someone if you actually want to implement these. But maybe the biggest takeaway is if you have a Bitcoin or a couple Bitcoin or something, you have options. When you retire, if it's 5 years, 10 years, 20 years, 30 years, you will have options. You have different ways of making money, of taking loans, of making yourself be able to live on the Bitcoin or in addition to everything else you have going, right? So this is, I think, a really cool thing that has happened specifically over the last year. We have not had access to some of these ways of retiring on Bitcoin up until now. Let me know your thoughts on all this underneath the video, though. If you do want to trade crypto, there's the link to Margex where you can trade all different kinds of assets in one place using different forms of collateral, which can get really interesting. As I said earlier, can help you outperform. Of course, do your own due diligence. Thank you so much for watching. Hit subscribe if you want to see future videos like this. I have some other Retire on Bitcoin videos as well where we go through different scenarios and different assumptions. So check those out, and I'll see you in the next video. Bye.